Jim Bullard, are we so messed up right now that we're finally, once and for all, going to shift to the targeting of nominal GDP instead of a real GDP analysis?
I've been an advocate, as you know, of nominal GDP targeting and its close cousin, price level targeting. The committee is still formulating about its framework review, and hopefully we'll get some statement out on that sometime during the rest of this year, but it's up to the chairman to drive that process.
Mr. Orphanides, years ago, wrote a landmark paper, I believe in the Greenspan Fed, about the toolkits that are out there and the toolkits that are available. What does the Bullard and the Fed toolkit look right now? It seems like you've exhausted an awful lot of the useful tools.
I think there are other things we can still do, but we have deployed a lot of good tools for this situation. I think the policy response has been quite good to the pandemic, both on the monetary policy side, the liquidity programs, plus a good response from the political side to get fiscal relief to those that are disrupted by the pandemic. So I think all of this has actually gone, given the nature of the shock and the depth of the shock, this has all gone pretty well so far. And I think July 1st is a good checkpoint because I've long advocated that the main impact will be in the second quarter of 2020. And its third quarter will be kind of the opposite of the first quarter. First quarter is a big decline. Third quarter will be a big increase as many businesses come back online safely in a way that keeps the pandemic under control.
Jim, it's Jonathan here. I know the committee's thinking a little bit more about forward guidance. I caught up with President Mester and President Williams in the last month, and yield curve control was a bigger part of the conversation. Can you walk me through how you would characterize yield curve control from your perspective? Is that a complement to forward guidance, or is that something bolder where you cap yields at the longer end?
Yeah, the U.S. had yield curve control during World War II, and then after the war, the exit from the yield curve control was very difficult, so it kind of ended in tears. So I think that's one of the main concerns about going in this direction. Japan, as we know, has done yield curve control, but one of the things that they wanted to do was get out of the quantitative easing program. They've scaled that back dramatically by just targeting yields directly. So I think there are a lot more questions and answers around yield curve control right now.
What do you think the optimal approach to forward guidance is then, Jim?
Well, I think we're giving great forward guidance right now, and I think there's really no problem with where we are today. We're projecting low rates of, policy rate far out into the future. Longer-term yields are also quite low. Global yields are quite low. So, and we have the advantage in the current situation that we already built up credibility for low rates and commitments to low rates through the last crisis. In the last crisis, there was, as you might recall, coming out of that in 2010, 2011, 2012, the markets were always expecting that yields would leap back higher at any moment. And the committee tried to fight back against that and keep yields low, all up by promising low rates further into the future. But in the end, we built up a lot of credibility that we really meant it, that we were going to keep rates low. And so this time, we have a lot of credibility on this issue, and I just think we're in great shape for right now because of the credibility we built up last time around.
Jim, the market definitely is buying that rates will remain low for a long time. Back in 2015, you raised the issue of asset bubbles that will come on the heels potentially of leaving rates so low for so long. Given how much corporate debt issuance we have seen, what's different now?
Yeah, I mean, bubbles is always an issue, and I do keep my eye on it. But again, I'm just not seeing things that are of the same magnitude as what happened in the late 1990s. the internet so-called .com bubble that blew up on us, and then the much more serious housing bubble in the mid-2000s that also blew up and turned into a global crisis. But I'm not seeing anything like that right now. We do watch it closely. I understand that companies are taking on debt. Some of that's, liquidity driven to get through the pandemic here. They're drawing on lines of credit and other sources to make sure that they can survive and thrive through a time of low revenue for their business. So so far so good, but we'll certainly watch this closely.
Jim, are there no negative consequences then to keeping rates basically at zero for the indefinite future?
Yeah, there's always inflation risk lurking out there, but we haven't had an inflation problem in the U.S. or globally since longer than most of us can remember sitting here. So the problem has been on the low side and the threat of disinflation or deflation. On that score, I think we're also avoiding that risk, at least for now. I see TIPS break-evens moving back up in recent weeks, which seems to suggest that the committee retains credibility around its 2% inflation target, even though we've missed that target somewhat to the low side. It hasn't been as good as we wanted, but we have kept it, relatively close, and I think we'll be able to do that this time as well.
Jim, it's not the presence of bubbles that I think gets my attention. It's the absence of creative destruction. And I want to ask you an important question. Why the Fed seems to have lost confidence in the transformational powers of capitalism?
Well, you'll have to talk to others. I have not lost faith in the transformational powers of capitalism. I think what you're seeing today is tremendous adjustment by so many businesses to unwelcome development where we had this disease descend upon us. We've learned a lot about it in the last 90 days. We're figuring out how to run businesses, deliver goods and services in all kinds of nooks and crannies around the economy in ways that keep everybody healthy, keep the customer safe, keep the workers safe, and still, keep household incomes up and keep people employed. So I think we can be successful on this dimension. There are a few businesses where the pandemic is really throwing them a curveball, and they really have to hustle and roll up their sleeves in order to think about how they can deliver their product in this new environment. But for most businesses, I think they'll be up and running in the second half of the year.
Jim, I totally appreciate the motives of the Federal Reserve to do what the committee has done over the last couple of months, but I think we do need to talk about the consequences. Once you introduce a price-insensitive buyer into the credit market, you are interfering in the transformational powers of capitalism. You are stopping the money from flowing away from bad businesses to good ones. Do you not appreciate that, Jim?
No, I do, but I think the key question here is bad businesses. What do you mean by bad businesses? If they were viable and successful before the pandemic came, most of those I think are going to continue to be viable and successful in the world ahead, where we have to deal with the disease. There may be a few that don't manage to make that transition. I don't know. But the demand for those products is still there, and I would say for most firms, they want to maintain liquidity during the crisis here, and they'll be able to get back up and running with some changes to how they deliver goods and services in the second half.
We welcome all of you. Our extended conversation with Jim Bullard here on our simulcast on Bloomberg Television and Bloomberg Radio. He is the president of the St. Louis Fed and has been exceptionally acute in his research over his 12 years at the Fed of advancing not controversy, but just the argument of the moment. That argument of the moment, I have to revisit it, Dr. Bullard, is yield curve control. And what I find so distortive here is the Fed will make an action, the Fed will make a statement, there'll be a speech, there'll be some form of announcement, and you know better than anyone, the market will react to that. Can't the markets adapt to yield curve control and diffuse any benefit of it, diminish any benefit of it?
I do not think that the markets would undo what the Fed is trying to do. I think it's an equilibrium. I think we've enforced that equilibrium by trying to be more transparent about the debates and ideas that are going on the committee and the analysis. I think there's a lot of give and take between markets and policymakers, much different than it would have been in the very shrouded days of the 1980s, where we barely said anything. And
Right.
markets had to infer what was going on. So I think that transparency is useful. I think we're wrestling with these ideas just like everyone else. But I think that it helps inform the equilibrium to be as transparent as possible.
But this, extremely well said, Dr. Bullard. Now, we have Dr. Williams of the New York Fed and Governor Brainerd, and they've made some comments on the efficacy of yield caps. I look at you and others more circumspect as well. If we do yield curve control and we distribute that out the yield curve, and I don't know what year or month or day you're going to extend it out to, do we set ourselves up to be more vulnerable to any given exogenous shock?
I'm not sure about that. You'd have to, it kind of depends how you interpret the Japanese experience of the last few years.
Yes.
A few other countries that have tried this in the modern era. I just think, right now there are more questions than answers about this, and I don't really think this is a pending thing for the committee because we're already expecting rates to be low for quite a while. So I'm not sure that you need to put caps in or anything else. You've already got the low expected rates that you desire for this situation.
Well, very quickly, Dr. Bullard, what does yield curve control mean to retirees and savers in the St. Louis district?
Yeah, longstanding issue is that we should be thinking about the correct interest rates, not the lowest interest rates. That a lot of the discussion, popular discussion, always seems to assume lower rates are better. I think you do want to get to the equilibrium rate that makes sense for the current environment. But the current environment is one globally of very low rates all around the world, and that's the world we're living in. I think people have adjusted to that since it's been around since 2008, 2009.
President Bullard, a lot of questions coming through on the Bloomberg terminal that many people want to ask, including Mr. Gapin over at Barclays, who I think recognizes what a lot of people pointed out after the last Fed decision in the dot plot, why the long-term dot was still at 250. President Bullard, why wasn't that adjusted? And do you anticipate it will be in the coming meetings?
Yeah, as you guys may remember, I don't put in a long-term dot. I'm the only guy that doesn't do it. So I'm a rebel, maybe without a cause here. But I don't think we know enough to put down that long-term dot. And it affects expectations and it affects thinking in markets. But it's also the object for which there is the most uncertainty. So I would prefer not to put down some kind of guess about where we're going to be 10 years from now. No one knows. And talk more about the relevant time horizon for monetary policy, which is probably about 2 years, possibly 3 years at the very most. So I'm the wrong guy to talk about the long run dot.
President Bullard, you are the right person to talk about inflation, and you said that the Fed does retain its credibility around a 2% inflation goal. Are we measuring inflation right, or should we be taking into account asset price inflation, the inflation in housing costs, the inflation in medical and education costs, and even food?
Yeah, great question. The measurement issues around inflation are very serious. It has been studied extensively, but if you really get into the issues about how to construct a price index, it gets very hairy very fast. And one thing I would just mention on this measurement issue for right now is that during the second quarter, you have a lot of goods that were really not traded, in the normal volumes that they would have been, or volumes went all the way to zero. So what should you do with those in the price index? because they're always weighted by the shares of expenditure. Well, the share of expenditure went to zero. So are you not going to count those prices, or what are you going to do? Because you have markets that kind of shut down completely in that environment. So I think there are fascinating issues right now, just in the last few months, about how to interpret the inflation numbers. If you look at something like the Dallas Fed trim mean, which throws out the most extreme observations, it's still hanging right around 2%. And I think that's probably informing the market expectations about where they think we're going to end up with inflation.
Well, there's a question also about good inflation and bad inflation. A lot of people looking at the fact that wages are not increasing as quickly as some of these necessary costs that everybody faces on a regular basis. Are you seeing more bad inflation than good inflation, especially as there is this protectionist shift and people do bring supply chains back home?
Yeah, I think we were getting better wage growth before the pandemic. I think during the pandemic here, obviously we've asked people to stay at home, invest in the national health. We've asked businesses to temporarily shut down to invest in the national health. They've received probably somewhat inefficiently, but generally speaking, they have received relief from the federal government for their efforts to slow down the economy. So it's a little hard to measure wages or total income of households and businesses really during this time period. So I think we have to wait for the dust to settle. I think the third quarter will be a transition quarter. Like I said, I think most businesses will get back up and running and actually be close to the kind of production that they had previous to the pandemic. And then a few businesses will struggle more than that. But so far, so good. I actually think we're doing all right given the nature and size of this shock. I would say one other thing I just wanted to mention, and I don't know if you guys want to talk about it, but I actually think from a public policy point of view, we should not be emphasizing vaccines and therapeutics. I hope they happen, and God bless people that are working on it. I think they're doing great work and everything. But these are tough scientific problems, and that affects, from my point of view, I'm the economics guy. That's affecting expectations and affects how people behave. So I think what you should tell people instead is we're going to have to manage the disease. We're going to have to manage the risk that's out there. It's unpleasant, but there's a new mortality risk, and businesses have to adapt, households have to adapt, and everyone's doing that. We know that and we see that, but we shouldn't promise that there's some pot of gold at the end of the rainbow here.
President Bullard, that's exactly where I wanted to go, this idea that we have a very long road ahead of us. And there's a question about how resilient bank balance sheets are to deal with this. And it's something very much at the forefront of people's minds ahead of the stress test results that are coming out by the Federal Reserve later this week. Would you support having banks curb any dividend payments in order to shore up their balance sheets further ahead of whatever secondary effects, tertiary effects we can expect from the pandemic?
Yeah, this is a decision for the Board of Governors, so it's separate from the Open Market Committee, which I'm on, so it's not really my purview. I would comment, however, that I think markets have probably already priced this in. My sense is that the Europeans have already ended dividend payments, and markets probably expect something like that to happen in the U.S., but it's up to the governors on to how they want to look at that. We've got the stress test results coming up shortly here, and I think that'll inform how the governors want to go on this going forward.